That's 866-848-5699, or you can request the guide from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
The Financial Exchange and Veterans Development Corporation are proud partners of the Disabled American Veterans Department of Massachusetts. The DAV provides thousands of hours of voluntary services at our VA medical centers and is the only DAV department in the country to lead a veterans housing initiative for single veterans and for those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit davma.org. That's davma.org.
Financial planning is a year-round job, and with 2024 coming to an end, now is the perfect time to take a hard look at your strategy and what changes you may want to make going forward. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and our new guide may help you understand some key numbers that could affect your planning next year. There are many important topics to review, like marginal tax brackets and retirement account income limits. If you're retired or getting ready to retire, the guide also focuses on the many ways that the government taxes your Social Security benefits. Take the time now to reflect on your current strategy so you can be fully prepared for any adjustments you may want to make in the future. Get your copy of our new guide, Key Numbers to Know for 2025, by calling 800-393-4001. That number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
As a busy mom, my to-do list is full.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has information to help you and your family live a healthier life.
Visit goredforwomen.org/momlife today.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zada and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zada and Paul Lane.
To be clear, I don't think we actually have Chuck Zada or Paul Lane on today's program, but it's Mike Armstrong. Marc Fandetti, are you there today?
Yes. Hey,
well, Merry Christmas to everybody yesterday, and welcome back to the Financial Exchange. Happy Hanukkah. I think Kwanzaa kicks off today. And, I had a wonderful, maybe somewhat stressful Christmas. And, I hope everyone had a nice little time off. Ben, what was your favorite gift of the holiday season?
As always, I got a new watch. Can't complain about that.
Yeah. I forget that you are a collector of watches, so yeah, that's an exciting new gift for you.
I think you meant I'm a fool.
But welcome back here to the Financial Exchange. As you would imagine, not a ton of big
power-hitting economic data coming out this week. We did get one read on jobless claims, but we'll be talking a little bit about where markets have been over the course of the year, and frankly, a pretty interesting last week or so with the big market sell-off following the Federal Reserve announcement and press conference, followed by mainly a regaining of all those losses. But we want to start off with, I think, a well-timed piece, since I'm talking about holiday stress anyway, which is the Federal Reserve's stress tests, and the biggest banks in the country planning to sue the Federal Reserve over these. So I guess if we could start off, Mark, and I know that you haven't worked directly in banking regulation before, but these stress tests were created post-Great Financial Crisis in order to do what exactly and prevent what in the future?
To prevent bank failures, to make them less likely. The history of this, Mike, goes back. A lot of us were watching It's a Wonderful Life over the weekend. That's a movie about a bank run, right? And the contagion that sets in, the panic that sets in. So in the 1930s, we got the Federal Deposit Insurance Corporation. We got what used to be called FSLIC, which covered savings and loans. And incidentally, Bailey Savings and Loan, I'm probably one of the few people who watched the movie and thought about this. I don't know what this says, would not have gone bankrupt at that time period because we had FSLIC to protect savings and loans. It came out of the New Deal. The price that banks had to pay for this insurance, for this cushion, that really protects them from their own stupidity, protects them from making bad loans that right? It does.
Blow up and ruin the bank, yeah.
It's why some banks are too big to fail. Really, every bank is too big to fail under FDIC insurance. That's because banks, again, when they fail, there's a domino effect. Contagion sets in. But if you watch This A Wonderful Life, you saw a bank contagion unfold. The idea behind these capitalization requirements, first the New Deal, FDIC capitalization requirements, and by extension, those that we imposed after the Great Recession, they're meant to protect ultimately depositors from bank failure. Banks hate these because because of contagion. One bank we saw this with Silicon Valley Bank. Last year, the reason the Fed stepped in is because they felt like they had to choke off any potential contagion effects. Banks hate these requirements because they effectively cap their profits. They love to make riskier loans. They love to loan out all the capital they don't think depositors are going to call on any given day. Can't do that. That's the cost of insurance and the price we pay for stability.
So the SVB example is a good one because these specific stress tests that they are suing over were enacted, I think, as part of Dodd-Frank during the Great Recession, and they specifically require testing of all banks with assets over $100 billion, and if you're over $250 billion, these tests occur every single year. If you're under that, if you're between 100 and 250, then it's a biannual testing that they do. And I find the SVB example, interesting because SVB did have assets over $100 billion, meaning they were subject to these tests, although they just crossed the threshold in November of 2021. So they actually never underwent a stress test prior to them failing, which just kind of interesting tidbit. Who knows? Would the stress test have actually tested for this? And I think that's probably a lot of the criticism from these banks is, look, these tests aren't relevant. They are opaque. It's unclear what metrics we're going to be judged on, which ones will be ignored. And so, many of the lawsuits have said, look, we're not opposed to stress testing. We just want a clearer set of rules and regulations as to how they're going to be conducted and what they're going to be looking for. But I do find it interesting, and the pendulum always does swing. Yeah. And I think arguably after the Great Recession, for good reason, we swung the pendulum very far in the direction of regulation and control. Yep. And look, we don't want these banks to, we can't prevent these banks from getting too big. That was the decision we made over the last several decades is we're going to allow banks to get enormous. But once they get to a certain threshold, and $100 billion was just sort of chosen here, we're going to regulate them almost in the way that we might a utility so that if one of them fails, we don't have a systemic failure of the entire financial system, which, to be clear, we got really close to in 2009, right? We got very, very close to a complete failure of our entire financial system of order. And so that's why these rules were put in. Are they inefficient? Are they probably outdated and not very clear for the banks? Yeah, I'm certain.
Yeah, right. It's tough for us to speak to that.
All sorts of things.
It's tough for us to speak to that. I think the key point is the one. I'm sorry, Mike. I interrupted you.
You're fine. Keep going.
You made the point about the pendulum swinging. I think that's the big picture critical point to take away from this. The environment is. We get a new regime on January 20th. They are committed to reducing regulation, including banking regulation. I've heard a couple of prospective, I don't know if they speak for the president-elect or not, or if he even has any well-formed views on this, but some have suggested eliminating or seriously hamstringing, for lack of a better verb, the FDIC. That would be consistent with your pendulum swinging thesis, Mike. We're just moving in the direction of deregulation after a period of more severe regulation. Unfortunately, as we learned, when we deregulated the savings and loan industry in the early 1980s, that can lead to excesses, which can lead to failures. A good chunk of the banking industry failed in the late 1980s. And in today's dollars, that cost nearly $1 trillion, $750 billion to clean up. So the inevitable result of the pendulum swinging is probably excesses, which of course is what causes the pendulum to swing back
in the other direction. I guess I have a few main points about this. One, from the perspective of the banks and from the lawmakers that want fewer regulations on those banks, they have a pretty good point, which is, look, we had these stress tests and it didn't prevent a massive bank failure in 2023. And so, what's the point of all these regulations if they're not even going to prevent a massive bank failure? On the other hand, if we're going to move all of these regulations back, and I'm sure there will still be stress tests, but maybe less burdensome ones that allow banks to pay out more dividends and more profits to their shareholders, and maybe conduct business that was previously thought of as too risky, is okay. Well, how would you have handled the SVB situation differently?
But Mike,
I think that's an important question to answer. Not that we're going to necessarily have another SVB, but assume that doing this will result in another bank collapsing in some way, shape, or form. Are we going to take the same drastic measures and bail out every single depositor at that bank?
Yes, we are.
Even if they're above the FDIC limits?
Yes, we are. We're going to do exactly what we did to stem contagion. And by the way, just because the stress and I can't defend them, this is not my area.
Sure.
Maybe they are too stringent. Maybe they could be streamlined. I don't really know. But Silicon Valley Bank's failure is not evidence that the stress tests failed. The stress tests may have prevented overreaching by banks in other areas. We don't know what disasters the stress tests prevented. You could say this with respect to any government regulation.
Sure.
People rail against it. People rail against TSA, for example. It's inconvenient. They may have. We'll never know how many disasters they prevented. That may be a bad example. I don't really know.
No, it's a fair one.
You don't see the prevented disasters.
Right. Yeah, precisely. Let's take a quick break. When we come back, I want to really reflect on 2024, the Federal Reserve's actions, what they seemingly did well based on the results we're seeing, and then the inconsistencies. There's a piece out here, an op-ed piece about the Fed setting some New Year's resolutions. Let's talk the Federal Reserve next here on the Financial Exchange.
Wall Street Watch, a full update on the market's performance to date. Weekdays at 10:30 only here on the Financial Exchange Radio Network. If you're retired or nearing retirement and haven't done your planning yet, you could be missing out on opportunities that can save you thousands of dollars. Cushing & Dolan are experts in elder law and taxation, and they have a new guide out this month called Balancing Asset Protection and Avoiding Estate Taxes. Early estate planning can have many benefits, especially if you want to protect the assets. But there's another big advantage. Doing your planning the right way might also help you eliminate your estate taxes. Learn how to keep your assets in your family and avoid probate. Get Cushing & Dolan's brand new guide called Balancing Asset Protection and Avoiding Estate Taxes. Call right now, 866-848-5699. That number again is 866-848-5699. Or you can request your guide online from our website, LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Chuck Zada from the Armstrong Advisory Group. Your lifelong financial plan should always be top of mind, and as another new year approaches, now is the time to review some key numbers that may affect your strategy going forward. Our guide walks you through several important numbers that you'll need to be familiar with for 2025, especially from a tax standpoint. It's called Key Numbers for 2025, and in it, we'll explain marginal tax brackets for both married couples and single filers, as well as information about the standard deduction that'll be pivotal for your financial planning strategy. We'll also explore other areas like the federal estate tax and gifting limits. Call us right now at 800-393-4001 and ask for your free guide today. That's 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network.
The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. With the holiday season now here, now is a great time to say thank you to our great American heroes by making a donation at dav5k.boston. Your gifts will support services such as the Veteran Advancement Program, which offers permanent and affordable housing opportunities for veterans and their dependents. Thank you again for your support.
Piece this morning from Jason Furman. He's an economist, professor at Harvard University. He was a Barack Obama appointee to the Council of Economic Advisors. I bring up his background because I feel like a lot of the criticism of the Federal Reserve recently has been coming more from the right, and this is one that's maybe not direct criticism, but a bit of a reflection on how they work. And one piece that he brought up I thought was pretty compelling. Going into 2024, the Federal Reserve anticipated economic growth of 1.4%, inflation of 2.4%, and 3 rate cuts. Instead, what they got was economic growth of 2.5%, inflation of 2.8%, and yet 4 rate cuts. And so I think he kind of asked the question, what gives here, right? Like, if you use any sort of basic framework for how you would implement Federal Reserve policy, you got more growth and more inflation than you were anticipating, and yet you cut rates more than you were anticipating at the beginning of the year. And so he kind of puts together an argument for more of a rules-based approach to inflation and unemployment, the Fed's dual mandates. And I'm interested in your reflections on that, Mark. To me, I don't know that the Fed's problems are more of a need for a rules-based system as it is just a problem with interpreting and acting, and a pretty consistent push for lower interest rates regardless of the scenario.
Those two things are related. This is a remarkable piece from Jason Furman because he's left of center.
Yep.
He uses the same models that all economists do, but he served in Democrat administrations. All else equal, he would prefer, for example, more equality to higher growth. I don't want to speak for Furman, but my guess is so there is a certain, say, set of beliefs that he and people who subscribe to the things he does hold. So it is remarkable that a left of center, slightly left of center, he's level-headed, he's objective, he's brilliant, he's universally respected. But it is remarkable, the equivalent of Nixon going to China, that someone on this end of the spectrum would advocate a rules-based approach to monetary policy. So this is not a Milton Friedman rule. Some of you will think of Milton Friedman, who said you just grow the money supply at 2 or 3% a year. You don't need a Fed. A computer could do that. He's talking about a different type of rule. Some of you have heard of the Taylor rule. John Taylor, guy out of Stanford, he's one economist who in the early 1990s did a lot of research on how central banks behave. Do they just follow their whims and instinct? They used to do this. Since Greenspan, though, it's been widely thought that banks generally follow rules, which makes sense when you're dealing with something as complicated as monetary policy. The reason it's remarkable that this comes from Furman, and it's the equivalent of, again, Nixon going to China, is that people who are somewhat left of center have generally favored discretion because they generally put more weight personally on keeping unemployment low than on keeping inflation low. You got to keep that trade-off in mind. So a rule in Furman's mind would allow us to better understand what the Fed's thinking. Why did Powell cut last? I'm saying Powell, I mean the FOMC. Why'd they cut last week? Growth is growing above potential. Unemployment is low in historical terms. Inflation is not yet at their goal. What are they thinking? If they were following a rule, even a generally defined one, it would give us a better window on their thinking, to your latter point, Mike.
Yeah, and look, I hear all those arguments, and I think they are reasonable, especially given the mistakes that the Federal Reserve very clearly made in 2022 and 2021, for that matter. On the way up on inflation, they really missed. They missed the opportunity. They missed the ball, and we might not have dealt with as high inflation had they, implemented proper policy. And I think that speaks to their bias for lower interest rates that we've seen pretty persistently over the last 4 years. My problem with the piece is it's tough to argue with results. And the results that you're getting today, even if they are just the result of good luck, are an economy that seems to be growing faster than what most economists would assume is the long-term potential, and inflation that is getting into the category of let's just forget about it. It's not that big a deal. Right? Would you categorize it any differently in terms of where we are
We're
today?
In a good spot now. Had they been following some sort of coherent rule, even a very broadly defined one, and all of these Taylor-type rules have one proviso in common, one rule, one sub-rule in common, which is when underlying or core inflation goes up, you raise rates more than 1 for 1. Otherwise, real rates are coming down. If inflation is going up, you're not raising rates as quickly as inflation is going up. Real rates are coming down. Policy's actually getting easier, not tighter. That's what these rules avoid. And I think if Furman had the time and felt the need to expand, he would have made that point because it's central to rule-based operation by a central bank. But yeah, Mike, we got to a good place. Could we have gotten to a good place quicker or avoided the most unpleasant parts of the bad place we were in 2021, 2022 if the Fed were raising rates more than 1 for 1 with inflation, which is how I think about the most important part of these so-called Taylor-type rules? Maybe it would have been a smoother path, Mike.
Yeah, and to be clear too, it's not as though anyone is arguing that they have to create a series of rules and then plug it into an algorithm like some sort of algorithm-based trading model. I think Jason Furman most certainly is saying no, keep your discretion to diverge from these series of rules based on what's actually going on in the economy. But when you seemingly have no framework for when you're going to hike or raise rate or hike or lower rates, you get things like this year where, again, I go back to that piece from the beginning of this year where they were only anticipating lowering rates 3 times. And we got data that was better than they anticipated. Higher growth, higher inflation than what the Federal Reserve themselves were anticipating. And yet they cut rates more aggressively than they thought that they would.
Right.
And so that is pretty confounding.
Yes.
And I do have to sit there and say, look, this is what you anticipated. You got stuff that was better, and yet you defaulted to lower rates instead. And we haven't got really much of a useful explanation on that.
Well, and this
has been, we don't believe this data point because we think that the inflation that we're seeing there is just fake and it's going to disappear, or we're suspicious of these growth numbers. They seem temporary and we're worried about things collapsing.
Right.
That sort of explanation would be very reasonable to me, but we haven't gotten that. We've just had, things have been better than expected, but we still think that rates need to go lower, and we think that's going to be fine, without much of any explanation as to how that affects the neutral rate or really anything else from the Federal Reserve. And those are the inconsistencies that I think an incoming Trump administration can and should rail on when they criticize the Fed, is this inconsistent thinking. The problem is that would actually result in higher rates, which Donald Trump most certainly isn't going to want.
Yeah,
let's take
Trump's the farthest thing from that.
Let's take a quick break. When we come back, we will have a full market update with Wall Street Watch. Had a few good sessions leading into the Christmas holiday. What are we seeing today? That's next here on the Financial Exchange.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Heads up, athletes, coaches, and parents. Play for life, not just points. Hypertrophic cardiomyopathy, or HCM, is the leading cause of sudden cardiac death, especially in black athletes in sports like football or basketball. If you feel shortness of breath, chest pain, and fatigue, or have a family history of HCM, talk to your doctor. Don't let HCM bend you for good. Learn how to stay in the game at heart.org/HCM student athlete. Your heart, your health, your move.
Protect your assets and avoid tax consequences by getting Cushing & Dolan's new guide called Balancing Asset Protection and Avoiding Estate Taxes. You'll learn how to keep your assets away from the nursing home while potentially eliminating your estate taxes. Get yours today by calling 866-848-5699. That's 866-848-5699. Or request it online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
The Financial Exchange and Veterans Development Corporation are proud partners of the Disabled American Veterans Department of Massachusetts. The DAV provides thousands of hours of voluntary services at our VA medical centers and is the only DAV department in the country to lead a veterans housing initiative for single veterans and for those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit davma.org. That's davma.org.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, You'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Key Numbers to Know for 2025. Mike, when it comes to 401ks and their contribution limits, 2025 is a little bit unique in that it is the first year of the super catch-up limit.
It is, yeah. So there's a brand new contribution excess amount that you can put into your retirement plan, but only for a very specific window. You must be between the ages of 60 and 63 to participate in this special super catch-up contribution, according to the Secure Act 2.0. And so there's a little bit extra that you might be able to put in if you fall into that age demographic.
So how much is the normal 401k max? How much is the regular catch-up? And then how much is the super catch-up?
Yeah, so for the normal 401k contribution limits, the most that you can put in 2025 is going to be $23,500. If you are over the age of 50, you can do an extra $7,500 into that 401k. And then finally, if you just happen to be in that narrow band, you can do an additional $3,750 catch-up contribution on top of everything else that we already went through.
Folks, our guide this month is titled Key Numbers to Know for 2025, and this is just one of the numbers that's included in it. We also have discussions about IRA contribution limits, tax brackets, a whole bunch of different things that are included in here. How do you request the guide? Call 800-393-4001. That number again to request the guide is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, a lot of red on the board for the major indices. The Dow Jones is down 72 points. The S&P 500 is down just under 10 points, or 0.16%, and the NASDAQ is down just under 30 points as we speak. Taking a look at some of the companies around the globe, GameStop shares are up 4.3%, extending their gains from Tuesday. The video game retailer has risen 4 straight days and has climbed more than 77% in 2024. U.S.-listed Honda shares are up about 3.8%, bringing this week's advance to about 14% on the heels of merger talks announced at the start of the week with fellow Japanese automaker Nissan. The move also comes amid rally among Asia-Pacific stocks following a report that Japan's government is reportedly set to propose a record $735 billion budget. Starbucks shares are up 1.7% after the coffee chain's workers expanded a strike earlier this week. The holiday work action now affects more than 300 stores in 45 states. American Airlines stock is down 0.72% after the Fort Worth-based carrier was forced to temporarily halt flights on Tuesday morning due to a computer glitch that caused a system-wide ground stop. American ended Tuesday 0.6% higher. I am Ben Kitchen, and that was Wall Street Watch.
Mark, piece here about deficits and something that we have focused on a fair bit that maybe has not gotten as much attention politically as some would hope. But to provide some context here, in 2023, the U.S. government deficit ran just over 6% of GDP, and I think that's a reasonable way to express it rather than talking about the trillions of dollars. I find that to be tough to understand and navigate, but if you think about it as a percentage of GDP, that's grounds you a little bit. And estimates for 2024, I don't know what you've seen, Mark, but I think it's supposed to be around the same. 6 to 6.5% of GDP is where the government's deficit will land. For some context, in kind of normal periods of economic growth. So think late 2010s, from 2014 right through 2019, we had deficits running anywhere in the 2.75% to 4% range. Throughout the 90s, for an example, early 90s, you were in that same 2.5% to 3% range before having finally some surpluses under Clinton in the late 90s. During big, drawdowns in economic activity, for example, like, 2009, you saw deficit to GDP rates close to 10%, and even more during COVID. You saw that more like 15%. And I guess just grounding folks here, I think the problem that anyone that is looking at things from a fiscal responsibility standpoint would be, wow, 6.5% is a pretty large deficit to be running when the economy is as good as everyone is telling me.
Yeah, it doesn't give you any room for error. Deficits, whether measured in an absolute sense or as a percentage of GDP, they always go up when the economy contracts because government spending goes up. Think increased unemployment benefits and other transfers and stimulus checks and all that, which are now routine. If we have an economic blip, they're going to start mailing out stimulus checks as fast as they can. It's just the way things are done now. So we're starting at 6.5%. As you pointed out, Mike, good economy, reasonably strong expansion in historical terms. What's going to happen if we have a recession next year? It's going to go to 8% of GDP, 10% of GDP. Again, that's almost a guarantee. So there's that. Then there's the overall amount of debt. And I'll stick with your rule of not throwing out numbers with 9 or 12 zeros after them today. And I'll just say that at some point, the cumulative deficits, which we call the debt, is going to be so high that markets don't want to buy our bonds anymore. I don't know when we reach that point, but it will come. And when that comes, interest rates go way up, and then tough choices get imposed on you. You have very little room to maneuver. I don't know when that tipping point is reached, but we seem willing to roll the dice on that.
Yeah, look, I tend to agree that this is a massive problem, but I also tend to think that the very clear evidence over the last 2 decades is that voters don't care about it.
No, they don't.
That seems abundantly clear to me, is that voters are not voting for fiscal responsibility. Those few that, ran on that didn't last very long. Paul Ryan is the last person I can think of that was fundamentally serious about this issue. I'm sure there are still other lawmakers still in Congress today that claim to be, and maybe they are, but none that are truly in power of things today. And I don't really know what can shift that, because people have been warning about deficits, well, since we've ever had one. And the problem with that argument is it's a bit of a boy who cried wolf. It hasn't become a problem, even though we've blown through barriers that anyone would have thought possible in the 1970s and 1980s and then 1990s. And so it just does not seem to be something that voters care about. And I kind of put it in the same category as housing affordability. Like, people recognize that deficits are a problem. They realize that it's probably fundamentally an issue someday, but they're not willing to really deal with the fixes to the problem, because as the author of this piece points out, it's not as though solving deficit problems are immensely complicated. It's not quantum physics. It's you have to spend less than you are taking in, or, a more reasonable approach might just be, hey, even if you choose not to reduce the total level of federal debts, just reduce the pace at which it grows. That's a pretty easy formula as far as I'm concerned, right? Raise taxes, cut spending. Is it more complicated than that?
No, but unlike
more politically complicated.
Right. It's more clearly, somebody's ox is going to get gored, and nobody's willing to step up and make the sacrifice until the cost of this recklessness, and it has been reckless under both Democrats and Republicans, until that cost is evident in the form of higher interest rates. And maybe we're moving into such a regime now with rates creeping up. I don't really know. Until people feel the pain, though, no, they're not going to act. But that's always been the case with us Americans. We don't respond to foreign threats until they're on our doorstep. We stay isolationist until we can't afford to anymore. We don't respond to climate threats until our until the ocean's at our doorstep, literally. It's just the way we are, and maybe people are more generally, Mike. I've sort of resigned to the fact that we're going to have a fiscal crisis. It's going to that will drag down our standard of living, and then we'll do something about this. And at that point, of course, it's too late. It's all pain. Think Greece. Right. They finally got out of their tailspin. It does not
seem like it's the type of issue that will just slowly and steadily become a problem. No. If that were the case, it seemingly would have happened already. It seems more like a situation that will arrive, like you described, will arrive on your doorstep and need to figure out in a very short
I think so, time. Mike. I think so. I don't know when that point is. Economists don't know.
Right. Let's take a quick break. When we come back, I want to talk a little bit more about potential Trump tariffs and specifically the automobile industry and how it seems to be preparing for what might come specifically with Mexico and Canada. Quick break. A little bit of tariff talk when it comes to car prices next on the Financial Exchange.
The Financial Exchange streams live on YouTube. Like our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
Financial planning is a year-round job, and with 2024 coming to an end, now is the perfect time to take a hard look at your strategy and what changes you may want to make going forward. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and our new guide may help you understand some key numbers that could affect your planning next year. There are many important topics to review, like marginal tax brackets and retirement account income limits. If you're retired or getting ready to retire, the guide also focuses on the many ways that the government taxes your Social Security benefits. Take the time now to reflect on your current strategy so you can be fully prepared for any adjustments you may want to make in the future. Get your copy of our new guide, Key Numbers to Know for 2025, by calling 800-393-4001. That number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Protect your assets and avoid tax consequences by getting Cushing & Dolan's new guide called Balancing Asset Protection and Avoiding Estate Taxes. You'll learn how to keep your assets away from the nursing home while potentially eliminating your estate taxes. Get yours today by calling 866-848-5699. That's 866-848-5699. Or request it online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today, we're talking about estate tax reduction and asset protection strategies that can help reduce or eliminate your estate taxes. Todd, there are some high net worth clients that would like to reduce the size of their estate, but they don't want to give up access to their assets. Is there anything they can do?
There certainly is, folks. So this is a combination of things. One, you obviously want to do your basic estate planning first. Get your foundation in place, the basic revocable trust planning to help utilize whatever exemptions you don't use up through gifting. Now, when we talk about reducing the estate, we are talking about gifting. But as you said, they don't want to lose control. So there are these special trusts that are designed called spousal lifetime access trusts, where in essence, you use an LLC to keep control of the investments, manage the investments, and make distributions. And then the non-voting shares get put into these irrevocable trusts where you have each other's spouse has access to the assets. So there's a way of getting the assets into those irrevocable trusts, which are now growing outside of your estate tax-free, while at the same time working together to keep control and use what's in those trusts.
The law firm of Cushing & Dolan have been helping families like yours for more than 40 years. Request your copy of Todd's brand new guide called Balancing Asset Protection and Avoiding Estate Taxes by calling 866-848-5699. That's 866-848-5699. 5699, or you can request the guide from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. If you missed any of today's show, catch up whenever you want on our YouTube page. Find daily show segments and full shows. Just go to youtube.com and search for The Financial Exchange. This is your home for breaking business and financial news. This is the Financial Exchange Radio Network.
Mark, let's get back to tariff talk here on the Financial Exchange. And I want to step away from the likely China tariffs and focus for a moment on our neighbors here. So today, 1/3 of all vehicles that are sold in the U.S. for under $30,000 are built in Mexico. A decade ago, that was only 1/5. So what seems to be happening there is those very low margin vehicles, which is, that's what they are. The Nissan Sentra, those small sedans. There's a reason that Ford stopped making sedans in general. It was not a high profit margin item for them. They make more money on pickup trucks. And in those vehicles, they're able to manufacture a lot more of it here domestically because those margins are a lot thicker. For those really low priced Civics and Nissan Sentras and Ford Mavericks, they do not make as much money for the automakers, and so they do a lot more of the production down in Mexico. And the piece here is saying, look, because of that shift, you're going to have the least affordable cars the most affordable cars become more expensive as a result of Trump's tariffs. I would argue that his piece here would be, well, the purpose of these tariffs is to make it so those vehicles are manufactured here in the United States, not so that car companies pay big tariffs on their vehicles. Honestly, I've heard of folks. I was speaking with somebody, for instance, just a few weeks ago who was planning on making a Subaru purchase before the year end because of concern about tariffs. And I have to say that this, to me, seems like one of the least certain areas of Trump's policies as to whether or not there will actually be tariffs imposed on two of our closest allies, Mexico and Canada. I don't know if you have any further thoughts on that.
No, I mean, are we gonna buy Greenland? Are we gonna take Greenland? Are we gonna negotiate for better rates in the Panama? Every day your head spins. My new attitude to survive the next 4 years with my brain intact is just to wait until we get something concrete.
I'm kind of there with you.
My guess is if someone told him this, Mr. President-elect, sir, there will be a huge adverse impact on less expensive cars. This is going to hurt a key constituency. He'd say, okay, let's rethink that, because he's a level-headed guy and he doesn't want to lose voters. So who knows what this is going to look like in terms of the final proposal. Maybe he'll do these things ad hoc by executive order, depending on which head of state upsets him from day to day. We have no idea if there's going to be any rationality to this.
From a logical perspective, if your end goal here is primarily to get China to the trade table here, imposing tariffs on Mexico is one of the really bad results could have from all of this, right? Because China's BYD has already been making big inroads into Mexico. They're opening manufacturing plants there. They're selling a lot of cars there at prices that, frankly, Chevy and Ford cannot compete with, and Stellantis can't compete with in any way, shape, or form. And so you go slap a bunch of tariffs in order to get production out of Mexico and into the United States. That's going to leave a big vacuum for influence and power from the Chinese. And I think that the Trump administration likely acknowledges all of that. The other piece that I just have to bring up once again on the unaffordability of cars, because they are immensely unaffordable, especially when you look at the average vehicle price out there, which, for anyone unfamiliar, hit about $48,000 for the average auto price in 2024 in the United States. Combine that with interest rates that are on average over 7%, and you get a very unaffordable vehicle market. And I will once again reiterate, cars are so expensive in the United States because we refuse to buy cheap cars. This is not the dealers and the auto manufacturers colluding to say, oh no, we're gonna screw the everyman and just build $50,000 cars. There's a reason Ford got out of the sedan market. Nobody was buying cheap sedans.
Also, they didn't know how to make a transmission. I drove one.
So both.
I have firsthand experience. It was not fun.
Yeah.
Anyway, yeah, you're right, Mike. And driving, as someone who still drives a cheap car, I can tell you it's not always fun. Rattles develop more quickly. The transmission shifts a little more roughly than a slightly nicer car. But the question is, do you want to pay $30, or actually I paid a lot less than that? But anyway, you want to pay $30, you want to pay $50?
Yeah, I just struggle with this argument so much. Like, these Jeep Grand Cherokees are so expensive. But like, yeah, look at the thing. Of course, it's expensive. The reason that cars are so expensive in this country is not because of trade policy or because of EPA standards.
I don't know,
it's
Mike.
because
we put tariffs on foreign
refuse
pickups.
to buy small cars.
Well, we tariffed the heck out of foreign SUVs and pickups and gave our domestic producers a huge advantage there.
Yep.
They would be arguably cheaper if we allowed unfettered
if we were
competition.
willing to import cheap
this is our
Chinese
future.
SUVs, then they would be a lot
Yeah, somebody
cheaper.
let J.D. Vance know that, please.
I think the overall problem remains a choice piece here, where Americans have a car buying habit that is immensely favored towards pickup trucks and SUVs, and we seem immensely willing to pay for those in spite of the grumbling that we do when we go to the dealership.
Mike is right. Americans do have a choice, and use that choice to go to the U.S. Virgin Islands. The islands are St. Croix, St. Thomas, and St. John. You can visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you, so head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Staying on the subject of vehicles, there's a piece out this morning, another op-ed piece, this time from Andrew Wheeler, who is a Trump appointee in the last administration to the EPA, on electric vehicle mandates. And to spell out where we stand according to him, the EPA currently effectively mandates that by 2032, automakers would have to shift at least 54% of their production to EVs and 16% to hybrids, which seems just like an unrealistic target that probably won't be hit even if the mandate were to stay in place. But there's discussion of, hey, is this something that the Trump administration can and would do on day one to start repealing these mandates? It's unclear to me if they will be able to without a vote of Congress. I don't think that he can just, appoint somebody that will change the EPA standards here. The other big piece that goes along with this, though, is California. California sets, as states can do, their own emission standards. And when you have a state as large as California mandating certain requirements from vehicle producers, they're not just going to say, oh, yeah, we'll make one car for California and a completely different set of cars for Texas and the rest of the country. And I do wonder if that's a battle that the Trump administration is going to engage in, is saying, hey, California, you cannot have stricter standards.
I thought these guys were for states' rights.
That would be my point here, is I hope they don't, because nothing to me seems dumber than a Republican administration trying to set standards where state rights get weakened, unless you just genuinely think that we're only going to have a Republican president for the rest of our lives. Because Democrats would be totally fine with states' rights being weakened, I think.
Yeah, both parties are in a little bit of a pickle here, because when it's convenient, they invoke federalism, which for some people means the federal government predominates in certain areas. For others, it means states can assert themselves in some domains. It'll be interesting to see how the courts come down on this. I assume it will be litigated if Trump tries to weaken California standards.
It certainly would end up in courts for an extended period of time. And quite honestly, I think that the Supreme Court would favor California on this one, where, hey, you want to create regulations that are more strict than the federal ones. Why wouldn't we allow that sort of thing? I just remind folks, try and keep into context that just because you agree with the way that one president is doing things, remind yourself that you won't always. There will always be a future where you disagree with those in power, and just empowering them to completely reshape the system, not usually a good idea. Markets remain here in largely negative territory. We'll have a full recap again in the second hour of the show, along with a heck of a lot more. Stick around, folks. We'll be right back on the Financial Exchange.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, the grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM, Concord, Boston. The Money Matters Radio Network. Protect your assets and avoid tax consequences by getting Cushing & Dolan's new guide called Balancing Asset Protection and Avoiding Estate Taxes. You'll learn how to keep your assets away from the nursing home while potentially eliminating your estate taxes. Get yours today by calling 866-848-5699. That's 866-848-5699. Or request it online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
The Financial Exchange and Veterans Development Corporation are proud partners of the Disabled American Veterans Department of Massachusetts. The DAV provides thousands of hours of voluntary services at our VA medical centers and is the only DAV department in the country to lead a veterans housing initiative for single veterans and for those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit davma.org. That's davma.org.
Hi, this is Chuck and Mike from the Armstrong Advisory Group. Our guide this month is titled The Key Numbers to Know for 2025. Mike, one of the questions that we get asked quite often is, how much can I gift in any given year without having to file a tax return or pay any tax on it? What does that number look like for 2025?
Yeah, there's a tremendous amount of confusion about this, Chuck. I think there's a lot of folks who assume that when you give a gift or receive a gift, there's taxes due at the time. And that is almost never the case unless we are talking about tremendous dollar amounts.
Sure.
In 2025, the gift tax exclusion amount is going up to $19,000 from $18,000. That means means that you can give up to $19,000 to any individual without having to file the special return of a gift.
What about if I am trying to make a gift in conjunction with a spouse? How does that work in terms of what we're able to do?
Yeah, I mean, you're able to double it immediately, right? So that $19,000 gets doubled. Keep in mind, too, that these are the gift tax limits per individual. And so you have seen people say, okay, I'm going to gift money to my son, my daughter-in-law, their 3 children. And in each of those cases, if you are married, that could be $38,000 per person without even have to file a tax return.
Our guide this month is titled The Key Numbers to Know in 2025, and it covers these numbers and a whole bunch more that can help you optimize your financial plan. We also have discussions about IRA contribution limits, tax brackets, a whole bunch of different things that are included in here. How do you request the guide? Call 800-393-4001. Again, that number is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Visit one or all 3 and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Are you retired like me, and you just found out you owe the IRS a ton of money? Well, what would your life be like if they took your retirement savings away from you? They can do it, and your property. If you owe the IRS back taxes or you haven't filed in a while, the Tax Relief Line is here to help you. They can stop the IRS from taking your retirement savings. If you qualify, you could have your tax bill reduced to 0. That's right, if you're retired and you owe the IRS a lot in back taxes, you could have your entire tax bill reduced to 0 due. The IRS has now hired thousands of new employees, so they're ready to come after you. Don't let them take your retirement savings or property. Make this free call now.
800-251-2153. 800-251-2153. 800-251-2153. That's 800-251-2153.
Heads up, athletes, coaches, and parents. Play for life, not just points. Hypertrophic cardiomyopathy, or HCM, is the leading cause of sudden cardiac death, especially in black athletes in sports like football or basketball. If you feel shortness of breath, chest pain, and fatigue, or have a family history of HCM, talk to your doctor. Don't let HCM bent you for good. Learn how to stay in the game at heart.org/HCM student athlete. Your heart, your health, your move.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is The Financial Exchange with Mike Armstrong and Marc Fandetti.
Good morning. Welcome back to The Financial Exchange. Genuinely hope all of you had a nice little time off with family. I personally am still recovering from massive quantities of food that was consumed and just too much sugar is the consistent thing that I have around this holiday. But broadcasting today, I am at least from beautiful, foggy, and rainy Chicago, where we spent our holidays with my wife's family, and I get a little 2-hour break from that this morning. I'm sure they're all listening in the other room, so I should probably be quiet now. But markets today falling for the first time in 5 sessions. The Dow initially was down about 100 points, has made up a lot of those losses as we head into the 11 o'clock hour here. Dow currently off only 35 points, or about 0.1%. S&P about the same, 0.1%. NASDAQ a little bit worse for the day, but not substantially. The yield on the 10-year Treasury now up above, well above 4.5%, now sitting at 4.615%. And that is going to be, I think, probably the story that dominates 2025 is how longer-term rates are reacting to both what Jerome Powell's saying as well as actions from the new incoming Trump administration and what it might mean for both employment and inflation. But that 10-year Treasury now sitting at 4.615%, as I mentioned. In terms of what that means now for mortgage rates, because that's probably the one that matters a little bit more to the average American, those have now bumped all the way up to 7.1%, which is not quite the highest that it's been during this cycle. We did get up to more like 7.5% back in November of last year, but bumping right back up there to those highs, which can spell only bad news for the housing market come 2025. If you're a buyer out there, obviously you're facing those higher mortgage rates, and may be discouraged to go out there and buy. If you're a seller out there, your replacement rates, if you're locked into that 3% mortgage, it remains a far cry away from where we are today, and that, as it has for the last few years, seems likely to me at least to continue to lock up this housing market for a prolonged period of time. Taking a look at the active listing count for the overall housing market, and I recognize this time of year is not exactly a busy housing season, but nonetheless, according to the most recent data across the United States, there were 953,000 homes for sale. I believe that includes both single and multifamily units. That number, just for some framework, back in November of 2019 was sitting at 1.14 million homes for sale. And if we go all the way back to November of 2016, the context around when Donald Trump last took office, we were sitting at 1.34 million homes for sale. And so we have been climbing. We're getting to a more comfortable level of inventory, and I'm hopeful that the spring housing market shapes up to something. But yeah, with rates around 7.1%, I just don't see much relief coming anytime soon. At the same time, the yield on things like savings accounts and CD rates have been coming down as the Federal Reserve has cut rates 4 times in 2024. They do seem likely to pause at least somewhat in 2025 on those rate cuts as they sort out what the data looks like for 2025. Mark, any other items catching your attention this morning?
No, the rise in rates is interesting, Mike. I think the question on everybody's lips, or at least ours, is when do they hit like escape velocity? At what point do deficit concerns, the inflationary impact of tariffs, all else equal, tariffs raise prices. They are inflationary depending on the Fed's response. That inflation might become dug in. But at what point do rates just start barreling upward out of control? We were talking about this in the last hour in the context of when are people actually going to take action with respect to the deficit? It's huge, no matter how you measure it. They'll take action when they feel the pinch. Is this the start of a long and painful upward march in the rate the government pays to borrow for the long term, which has knock-on effects, as you point out, Mike, for what we pay for mortgages and some other things. Is this the point when, again, that number hits escape velocity? It's not going to obviously go up indefinitely, but to the point where people start to feel real economic pain as a result. Nobody knows.
And to be clear, I don't know where you would look for evidence, but I don't know that we see any evidence today that, for instance, there is not enough appetite to absorb the amount of treasury issuance that's going out of the federal government, that we have auctions that aren't going off well, things along those lines. Those to me would be early indications that, oh, wow, maybe this global appetite for U.S. treasuries isn't what we thought it was. And or public statements from large governments that, hey, they're going to hold off on buying more U.S. government because out of concerns about its creditworthiness. To me, I don't think that we've seen any evidence of that, but could it be getting filtered in through some of the plumbing? That I guess that's always possible. I just don't know that I don't know that anyone knows that it's going to be a 2025 or even before 2030 issue.
Yeah, I don't think it doesn't have to be an abrupt cataclysm or a dramatic event. It could just be the boiling frog analogy, which is terrible, but might capture what's going on here. You don't realize you're being boiled until it's too late. And is this upward march in rates? They're up a percentage point now. I'm talking about the 10-year Treasury, and that gets mirrored in mortgage, longer-term mortgages to a degree, are up a full percentage point since the middle of September. That's a big, quick rise.
I want to shift a little bit to the other big theme that has been really consistent throughout 2024, which is the excitement over artificial intelligence and how it might shape the future. And this is an interesting piece from, I think it's the New York Times today, about how artificial intelligence could reshape the economic geography of America. And here's the argument that it's laying out. The types of jobs that are very likely to be affected by artificial intelligence, at least according to this this New York Times piece, would be, finance type jobs, tech jobs where people are doing coding. We've seen results in those areas where, for instance, coders in jobs in San Francisco and other parts of the country, which are high-paying jobs, are far more efficient, and companies have been hesitant to expand hiring in those areas because of how much more efficient some of their workers have been. They're also some of the highest cost areas to live in the country. And so their argument here, at least, is that the Midwest, Mid-Atlantic, South would benefit or at least not fall quite as hard from the emerging artificial intelligence technology. And I have to say that I'm not sure I buy it for one even sliver of a second here. I just don't think there's much historically that would point to areas of the country being hollowed out due to technological innovation. I think you can say that about offshoring. There are large parts of the country today, part of the Midwest and the Rust Belt, that have fallen by the wayside in part due to our ability to import all sorts of stuff from outside the United States. But I'm just not sure that I buy that, for instance, New York City, San Francisco, and Boston are going to get hollowed out due to the innovation of artificial intelligence.
Well, it doesn't mean there's going to be mass layoffs. It just means you won't need as many people to do mundane tasks. You'll still need somebody with experience. You gave the example of coding. You can ask one of these things to give you a framework, but you still have to tweak the code. Just like if you're, say, an admin developing a PowerPoint presentation, your boss gives you a bunch of content, says, put this in a PowerPoint. AI could give you the shell, but you're going to need to put the finishing touches on yourself. That's something you may have needed a small staff in the past to do for you. You might have more time to devote to, I'm just using an example that we're all familiar with because everybody's had to put something in PowerPoint and knows how enormously frustrating it is to size things the right way and make them line up.
Let me just try and move this image a quarter of an inch. Oh, nope, now it's all completely
You want to put your
up.
fist through the monitor every time you use it, at least I do. So that will, in the long run, I think, improve everybody's productivity. We'll just need fewer people, Mike. I don't think it's a matter of mass layoffs and the hollowing out of big cities or anything that dramatic. And to the extent that
I guess my point would be, look, if COVID didn't ruin American cities, I just don't believe that a technological innovation akin to the internet is likely to do it. I just don't see how that, again, who knows? Nobody knows exactly how artificial intelligence is going to work out, but I don't see why the geographic impact is.
Just assume it improves productivity, Mike. We don't have to get into the weeds of how it's going to affect every subcategory of employment. Just assume it means slightly faster economic growth in the long term, though some heavyweights disagree strongly that that's likely to be the case. Mm-hmm. But suppose it does increase productivity and economic growth by just a little bit. In that sense, it's going to be akin to the internet, which did both of those things, though not permanently. Sadly, maybe its effects are longer lasting. Nobody knows. Take these long-term forecasts, especially the dire ones, with a huge grain of salt.
There is one piece that does seem, regardless of how effective it is in the short term or long term, regardless of how many jobs it eliminates, one thing that seems fairly certain, according to experts at this point, is going to be the demand for electricity. And that is one piece that I find confounding and interesting. I'm optimistic on it, but very pessimistic in the short term. Utility stocks in 2024 rose about 20%. Some of them a heck of a lot more. Some of the unregulated utility, like energy generation companies, through the roof this year on massive new demand from these AI companies like Microsoft, like Meta, who have deep pockets to pay for it. In the short term, just fundamental basic economics here, what I see happening is immense new demand for electricity from a market that is not terribly elastic on the supply side. And Mark, you'll have to bring me back to Economics 101, but when you have a massive increase in demand without much increase in supply, usually I think prices go up.
If they're allowed to, otherwise you get shortages.
Yeah, that could be the other fascinating one, right? Generally speaking, all of our utility rates are heavily regulated by the states.
Yeah.
And so if they say, no, we're not going to allow you to charge more to our customers, then what happens? Do we have rolling brownouts and blackouts like they have in other parts of the country because of the massive new AI demand? Longer term, I think that you have new nuclear power plants, and there's already talk about a bunch of nat gas power plants going online specifically for some of these projects. So I'm optimistic long term, but in the short term, I think we have some really painful stuff to work out in terms of electricity generation and transmission. Let's take a quick break. When we come back, we're going to have trivia for you and then a couple more AI stories that I want to cover regarding Microsoft. That's next here on the Financial Exchange.
Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play the Financial Exchange. This is the Financial Exchange Radio Network. Protect your assets and avoid tax consequences by getting Cushing & Dolan's new guide called Balancing Asset Protection and Avoiding Estate Taxes. You'll learn how to keep your assets away from the nursing home while potentially eliminating your estate taxes. Get yours today by calling 866-848-5699. That's 866-848-5699. Or request it online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Financial planning is a year-round job, and with 2024 coming to an end, now is the perfect time to take a hard look at your strategy and what changes you may want to make going forward. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and our new guide may help you understand some key numbers that could affect your planning next year. There are many important topics to review, like marginal tax brackets and retirement account income limits. If you're retired or getting ready to retire, the guide also focuses on the many ways that the government taxes your Social Security benefits. Take the time now to reflect on your current strategy so you can be fully prepared for any adjustments you may want to make in the future. Get your copy of our new guide, Key Numbers to Know for 2025, by calling 800-393-4001. That number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about estate tax reduction and asset protection strategies that can help reduce or eliminate your estate taxes. Todd, there have been major changes with the Massachusetts exemption amounts. What is the new exemption for the state? Does that mean that a married couple living in Massachusetts with $4 million in assets could eliminate their estate taxes?
So, yes, there has been some changes. Now we're almost a full year in, of course, heading into a second year into the change. The change is now $2 million. It used to be $1 million for estate tax exemption. Now it's up to $2 million. And yes, if you are married, but you actually do trust planning, you can shelter $4 million. But folks, that doesn't mean that's all you do. For folks with $3 million that want to eliminate taxes, we can do that. But we can also think about protecting assets from the cost of long-term care. It allows us to do both a little easier now with a higher estate tax exemption. So think about ways in which you can use the irrevocable trust to not only shelter and be able to reduce your estate tax by sheltering up to $2 million on the death of each spouse, but also starting that important 5-year waiting period running to protect those assets from the cost of long-term care.
The law firm of Cushing & Dolan have been helping families like yours for more than 40 years. Request your copy of Todd's brand new guide. It's called Balancing Asset Protection and Avoiding Estate Taxes. You can call 866-848-5699. That's 866-848-5699, or you can request the guide from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Miss any of the show? Catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon, where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network.
All right, it's time for some trivia here on the show. No more Christmas trivia. No more Christmas trivia. Today is actor Kit Harington's 38th birthday. Kit rose to global fame for his role on Game of Thrones. So today's question is, which character did Kit Harington portray on Game of Thrones? Which character did Kit Harington portray on Game of Thrones? Be the second person to text us at 617-362-1385 with the correct answer, and you'll win a Financial Exchange Show t-shirt. The second correct response will be our winner. See the complete contest rules at financialexchangeshow.com.
Mark and Ben, I think I have a candidate here for least specific or useful article of the year. And I know we're closing in on the end of the year here, so we have a lot of them to cover here. But this piece, which is authored by Jenny Johnson, who, if you've never heard of her, she's the president and CEO of Franklin Templeton. She wrote in Barron's about artificial intelligence, and I'm not sure how many words she used here. It's a 15 paragraph piece here on artificial intelligence, and I can summarize it up in, I think, 10 words. People are optimistic about AI, but they might soon be pessimistic, which might be a good investment opportunity, but maybe not. I don't know if either of you read this thing, but that's the entirety of the piece, as far as I could tell.
No, I didn't see it. Is that
there's a lot of optimism about artificial intelligence, but usually there's some pessimism that comes in, and that could be a great investment opportunity. So keep your eyes open, I guess. I have no idea what anyone is supposed to do with this piece of information. She doesn't talk about any of the most exciting things happening in artificial intelligence, where they see the big winners or losers over the next few decades. I've got nothing from this piece that is, I think, even remotely useful, even to somebody that doesn't pay a lot of attention to artificial intelligence or business news as the two of us do. It just seems, I'm sorry, I am certain that the president and CEO of a company as big as Franklin Templeton is very well informed and smart, but this is a fundamentally useless piece of information.
I'm glad I skipped it. I said, I don't think Mike's going to get to this piece
there
today.
you have it. So let's get to one that I think actually is interesting here about Microsoft. So Microsoft was a major investor in ChatGPT owner, OpenAI, excuse me. And they have been using that investment and research that they've done on their own artificial intelligence assistants, which I haven't personally used. I know some folks who have not been terribly impressed by it so far. Generally speaking, the feedback I've had is, OpenAI's ChatGPT just does a lot of this same stuff a lot better. But nonetheless, they're starting to roll these products out, and specifically, they are rolling them out in some markets without much of the way of choice. You don't seemingly have many options when it comes to this. For example, they added their Copilot service to consumer subscription services for software, including Word, Excel, PowerPoint in Australia, as well as several other Southeast Asian countries. And now in those countries, if you want that bundled service of Word, Excel, PowerPoint, called Microsoft 365, you don't have any choice. The AI is put into those products as an automated feature, which is nothing new, but I think is being looked at a little bit differently when it comes to AI for some reason. Like when they roll out new software updates to Excel, Mark, you're a big heavy user of Excel. Like everyone just complains about it for a few weeks where they have to figure out where all their buttons went, and then you just kind of deal with it and move forward. But this seems to be getting a little bit more attention, I think, both because people aren't terribly happy with how Copilot's doing so far, and the fact that they're just tossing it into these packages and raising prices because of it.
Yeah, again, it may increase. I tend to think about this in terms of long-term economic growth because I can't really speculate. I've not heard many people speculate in interesting ways about its near-term impact. It's anybody's guess. It will probably, Mike, make people more productive in the long term, which should be good for economic growth. It will result in some dislocations. There will be fewer jobs for, say, support people. Admins keep coming to mind for me because that's how much of the content that we build in financial services gets put together. So that'll mean I can do more.
I'll volunteer that I think the first job that I had working for a major financial services company, mainly living in Excel spreadsheets, not really doing anything inventive, innovative, or uniquely decision-making. It was an entry-level job, right? I was learning how to do all this stuff. Most of those things that I was doing, if not eliminated by the use of artificial intelligence, certainly could have been, done a lot easier with AI by a more senior level person. So that is the piece that's interesting to me. How many of those early finance jobs are just deleted because of AI? Let's take a quick break. We'll have the trivia winner next. And then I also want to dive into millennials hitting their middle ages. Let's talk about that next.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
The Financial Exchange and Veterans Development Corporation are proud partners of the Disabled American Veterans Department of Massachusetts. The DAV provides thousands of hours of voluntary services at our VA medical centers and is the only DAV department in the country to lead a veterans housing initiative for single veterans and for those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit davma.org. That's davma.org.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Early estate planning is crucial if you want to protect your assets and avoid massive tax consequences. Cushing & Dolan are experts in elder law and taxation, and their new free guide can help give you just that. It's called Balancing Asset Protection and Avoiding Estate Taxes. In it, you'll learn how to keep your assets away from the nursing home while reducing and potentially eliminating your estate taxes. If you have an existing estate plan but aren't sure about your potential liability, or you need a new plan, call Cushing & Dolan today at 866-848-5699 and get this free guide called Balancing Asset Protection and Avoiding Estate Taxes. Don't leave your assets to chance. Call 866-848-5699. That's 866-848-5699. Or you can request your guide online from our website, LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Key Numbers to Know for 2025. Mike, when it comes to 401ks and their contribution limits, 2025 is a little bit unique in that it is the first year of the super catch-up limit.
It is, yeah. So there's a brand new contribution excess amount that you can put into your retirement plan, but only for a very specific window. You must be between the ages of 60 and 63 to participate in this special super catch-up contribution, according to the Secure Act 2.0. And so there's a little bit extra that you might be able to put in if you fall into that age demographic.
So how much is the normal 401k max? How much is the regular catch-up? And then how much is the super catch-up?
Yeah, so for the normal 401k contribution limits, the most that you can put in 2025 is going to be $23,500. If you are over the age of 50, you can do an extra $7,500 into that 401k. And then finally, if you just happen to be in that narrow band, you can do an additional $3,750 catch-up contribution on top of everything else that we already went through.
Folks, our guide this month is titled Key Numbers to Know for 2025, and this is just one of the numbers that's included in it. We also have discussions about IRA contribution limits, tax brackets, a whole bunch of different things that are included in here. How do you request the guide? Call 800-393-4001. That number again to request the guide is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Text us 617-362-1385 with your comments and questions about today's show. This is the Financial Exchange Radio Network.
All right, our trivia question today was, which character did Kit Harington portray in Game of Thrones? The correct answer, Jon Snow. Our winner today is Tom in East Longmeadow. He has won a Financial Exchange Show t-shirt. We play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
You just feeling generous the day after Christmas or something, Ben?
Yeah, why not?
I mean, I barely even watched
You
the
say
show
generous, I say
Jon Snow.
I didn't really want to work that hard and find a trivia question.
Also suffering from the food coma hangover from Christmas. Got it. Piece from, where are we here? Barron's today. Welcome to middle age, millennials. That doesn't feel great. Here's how to get your retirement savings on track. Kind of snuck up on you, but the youngest millennials are now 29 years old, the oldest 44 years old, and approaching middle age, with a majority of them having absolutely nothing saved for retirement. And the piece is, I think, a reasonable one to try and get your overall financial house in order. And I'm trying to kind of, look, I'm a millennial myself, putting myself in those shoes of, okay, if I'm in that 66%, by the way, which according to the National Institute for Retirement have nothing, sorry, the National Institute on Retirement Security, according to them, 66% of working millennials have absolutely nothing saved for retirement. And so I'm trying to put myself in those shoes of being in that position, and where do you even begin? Mark, how would you, I guess, begin to assess that situation, knowing that it's not your job to be a financial planner, but just looking at somebody who's in a position like that, or even younger, maybe first approaching saving for retirement? What's, I don't know, step one in your view?
Yeah, I guess if I were doing, say, 401k basics education for a big company, and it was a company that skewed young, as HR people like to say, a lot of young people in the workforce, you try to lure them into contributing. First of all, you're defaulted into your 401k plan these days. That's been the case actually for a long time, but wasn't for many decades. And we saw the results as soon as that was instituted. People stuck with their the savings rate into which they were defaulted, and that's typically the rate at which they get the full company match. So I guess, Mike, if I were dealing with a financially budget challenged and budget constrained young person, I would strongly encourage them to at least stick with contributing up to the full company match amount and investing in something that was age and risk tolerance appropriate. Also an automatic process with a modern 401k.
Yeah, I think a lot of folks just attach this stuff to being so insurmountably complicated that they don't know what to do about it. But look, the power of compound interest, I don't think I need to explain to any of our listeners, but I do think gets lost on people. And there's just a large segment of people that I think get a lot of choice paralysis when it comes to 401ks. I think is a great example there. Like, okay, what percentage am I supposed to be doing? Do I need traditional? Do I need Roth? And then, oh dear God, there's 50 different investment options here. How am I supposed to pick these other than throwing a dart at the wall? And I can understand that consternation. I think, there's some other unique challenges millennials faced, not specifically unique to their generation only, but, came of age with more debt on average than any previous generation, specifically student loan debt. I think for some reason, maybe this is just consistent across all generations, struggle with credit card debt. And I think if you're sitting in that employed position and trying to figure out, okay, how do I begin saving for retirement, or at least assess that situation, there's a few basic steps in my mind, and others have spoken to this. Ramsey, is a big proponent of it too. Like, first things first, you attack any high interest debt. And for me, high interest is like anything over 5%. You just say, hey, I'm going to do my best to wipe that out. Maybe if it's a home mortgage under at 7%, you might treat that differently. But if you've got a credit card or an 11% student loan, the difficult part there is there's very little likelihood that an investment you make in a 401k is going to do better than a 25% credit card debt, for example, on any sort of consistent basis. And so it doesn't oftentimes make a lot of sense to invest in that case. Beyond that, once those things are taken care of, you do need some form of emergency fund. Yeah, you can borrow against your 401k, but not if you're unemployed. And that's usually when those emergency funds are most likely to be needed. But then once there, it's all about having that discipline of saying, yeah, I am going to save for retirement. Even if I'm late to the game, I need to get started here and feel that effective compound interest. I think there's also this hesitation, Mark, that I hear from people all the time of like, oh, well, I don't want to buy in at markets at all-time highs. But, I mean, you tell me, Mark, you study this a heck of a lot more than I do. What happens after markets reach all-time highs?
Ideally, if you're young, you want prices to pull back. I know we're not all in that camp, right? So if you're averaging in, Mike, the whole point of making a regular contribution out of your paycheck is that you remove market timing risk, at least over the short term. As you get older, market timing risk gets more severe. But when you're young, number one, we all know that if the economy continues to operate as it has over the last, let's just call it century, a period over which large company stocks, as proxied by the Morningstar Large Cap Index, but you can use any similarly constructed one to get to the same conclusion. They've delivered low double digits, like 11, 12% a year, somewhere in between 11 and 12. That's including inflation. So that's not entirely representative of what you could buy with that level of return, but you get the point. Suppose markets continue to deliver something in that range. Some years a lot less, others a lot more. If with a 30-plus year horizon, you're going to be fine. Just average in, ride out the downturns. Indeed, you're buying stocks when they're relatively cheap during downturns. So,
and my other point too would be, even when things seem expensive or hit all-time highs, on average, what do stocks do after they reach all-time highs?
Oh, I'm sorry. Yeah, you asked that question.
They hit new all-time highs after that too, right? Like
Excuse me.
There's no statistical probability that once you hit that all-time high, get ready because it all comes crashing down. No, that's not on average what happens. I'm not saying it won't next time, but if you're finding yourself in a situation where you are unsure as to whether or not you are caught up on your financial security for retirement, if you are approaching that level or right in the midst of your working career and trying to assess, hey, where am I and will I be able to reach my goals by the time I'm ready to stop working, please give the folks at Armstrong Advisory Group a call. We offer free consultations for folks to specifically evaluate where they are in their retirement journey. We'll sit at the table with you and really evaluate these things with some framework to it to evaluate, hey, here's where I am today, and this is how I'm going to get where I need to be in the future. Give the folks at Armstrong Advisory Group a call. We offer these consultations throughout New England to folks. The number is 800-393-4001. We have people standing by to help talk to you about your financial security and your strategy for the future. That number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Mark, we have this story about empty nesters, and you and I covered it last week. There's some 20 million plus empty nester households out there. And just quick poll, like when you think about where your parents live, or Ben, where your parents live, or frankly, where my parents live, do any of them live in areas that you would consider to be pretty desirable for young families, like close to big labor markets and, that type of thing?
Well, my parents live in Framingham. Does that count?
So yeah, that definitely counts. They live in a desirable area for a family to be close to the Boston area. Mark, how about yours? Did they retire to a different area or?
No.
Okay.
My mom lives in a townhouse, so not suitable for families. Though some squeeze in there.
Sure.
They don't seem to be. Yeah.
The piece here that they're talking about is that there seems to be this optimism that, hey, once the baby boomers start downsizing, or, the undertone to this is frankly dying, then there's going to be this big unload of housing. But they make the point that they might not actually work that way, because the biggest concentration of empty nesters might not be in the places that younger people want to actually live. And there may be some truth to this. The highest concentration of empty nesters, which they define, I think, as 50 years plus and having two empty bedrooms in their home, so prime candidate for downsizing. That concentration is most heavy in Pittsburgh, Buffalo, and Cleveland. The highest concentration of young people in the country, I think they define as 40 years and under, are in San Jose, Austin, and Denver. And look, I think this is already largely reflected in terms of housing prices, but it does sort of raise the question to me as to whether or not a new supply of homes coming on the market in places like Maine, which has the average oldest population in the country, will actually do anything to fix some of our housing problems that exist in this country. I'm not really sure that waiting out baby boomers dying is a sound strategy for dealing with housing unaffordability, I think is my conclusion.
Yeah, what's going to fix it is a big decline in asset prices. Probably. Nobody hopes for that. But it's home prices are not going to continue to grow at a low single-digit clip after inflation indefinitely.
Yeah, I would think not. The other solution, if you want, well, maybe you don't want government involved quite as much, would be deregulation of the housing sector. But that seems to be another one that governments are really unwilling to take, mainly because the regulation that we have in the housing sector is not coming from the federal government. The regulation that we have in the housing sector is coming from my town, your town, and everybody else's town. And when asked, local residents aren't really interested in deregulating.
I don't want more multifamily housing in my town of Rentham. I sympathize. I moved there for a reason. I am part of the problem. I'm pro town choice. Yeah, I guess. And I know it sounds hypocritical to lament the so-called housing shortage, but at the same time say I don't want more multifamily housing and
I don't think that
you
frequently do
town.
lament it, Mark. Like I don't think you take many people. I think take a hypocritical approach to this and say, "Oh, we need to bring down the cost of."
Well, but we are lamenting it right now in this segment, or we're pointing it out as a problem and trying to identify solutions. I freely admit that I don't want more congestion in my little town. It's the reason I moved there in the first place. I got to fight congestion getting to Needham every single day. I'd rather not. I'd rather not live with that during my downtime. So I sympathize.
And I think you are in the majority here, Mark, which is why I don't think this is a very easy problem to fix here. People love the idea of bringing down housing costs, except when they're confronted with the actual solution. It's, again, similar to the deficit problem to me. Want to bring down deficits? Well, then you're going to get a lot less services from the federal government and your tax rates are going to go up. Oh, actually, I don't love that solution. Want to fix the housing problem? Well, they're going to build a bunch more houses near you. Do you like that? No, I don't love that. Oh, and by the way, the value of your home is going to go down if this works. Oh, yeah, I don't like that at all. There's no solution where we just suddenly bring down the cost of housing, but your house keeps its value.
Yeah, you've got to either move supply or... Sorry, Mike.
Good.
There's got to be movement on the supply side. You were just talking about some supply side solutions, which are meeting with resistance from blockheads like me. Or you can address it on the demand side, and some of those solutions.
You see me just agreeing to calling you a blockhead there? That was mainly why I was yeah. Let's take a quick break. When we come back, a little bit of stack roulette to finish up the show.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Like us on YouTube and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network. The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Protect your assets and avoid tax consequences by getting Cushing & Dolan's new guide called Balancing Asset Protection and Avoiding Estate Taxes. You'll learn how to keep your assets away from the nursing home while potentially eliminating your estate taxes. Get yours today by calling 866-848-5699. That's 866-848-5699. Or request it online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Hi, this is Chuck Zada from the Armstrong Advisory Group. Your lifelong financial plan should always be top of mind, and as another new year approaches, now is the time to review some key numbers that may affect your strategy going forward. Our guide walks you through several important numbers that you'll need to be familiar with for 2025, especially from a tax standpoint. It's called Key Numbers for 2025, and in it, we'll explain marginal tax brackets for both married couples and single filers, as well as information about the standard deduction that'll be pivotal for your financial planning strategy. We'll also explore other areas like the federal estate tax and gifting limits. Call us right now at 800-393-4001 and ask for your free guide today. That's 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much, and they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. With winter on it's here. Winter's here. Now is the time to start looking at a fabulous holiday vacation. There's no better place than the U.S. Virgin Islands. Enjoy perfect weather, world-class dining, incredible beaches, and a vibrant nightlife. No passport is needed and there's no money to exchange. Take your next vacation in America's Caribbean paradise, the United States Virgin Islands. Go to visitusvi.com to book your trip. That's visitusvi.com.
Mark, if it's all right with you, I'm going to kick things off on Stack Roulette here with about a bit of Nissan-Honda merger news. So if you haven't heard, there's consideration that Nissan may consider merging up with Honda, in which case likely seeing that Honda would be the dominant player there. They would become the third largest auto manufacturer in the world behind Toyota and Volkswagen. And largely see it as, hey, if it does happen, Nissan would face a lot of job cuts because, quite honestly, they sell in the same markets, and there's probably just, the main synergies that you would have there would be Honda basically doing a lot of the back office and manufacturing process for Nissan, which has very much struggled to define themselves and differentiate over the last few years. But speaking on the subject was Carlos Ghosn, and if you forgot about Carlos, he led Nissan until he was arrested in Japan on a number of charges, but mainly on the subject of financial misconduct. He then bribed someone, 2 Americans, to smuggle him out of the Japan in what I believe was concert equipment, and thereby avoiding those financial misconduct charges by going to a country that does not extradite to Japan. It would seem to me that once you do that, you kind of give up the ability to be taken seriously about your company anymore.
What are they going to do? Smuggle him in a speaker or something? He's not a big. He's not a big man. Oh, no, so I think they put him in a speaker.
Ben, maybe you can correct me if you remember this story, but I believe they smuggled him. They posed as like some sort of concert, back end people, and they had a giant box that they smuggled him out of his hotel room in, and got him out of the country. And yeah, again, once you get smuggled out of a country in concert equipment to avoid financial misconduct charges, I don't think you have any right to comment on the financial future of the company anymore.
No, you can't. You can't claim that you jumped into the speaker by accident. I was taking a nap. Next thing I knew.
What do you have for us, Mark?
Poor Jim Carrey. He recently. Did you read this story? I think there's a cautionary tale here, Mike. A cautionary financial planning tale. Obviously, a wealthy guy, did many movies. The going rate for him to star in the late '90s, early 2000s, we all know, was in the $10 to $20 million.
He was the first $20 million movie guy.
Yeah, right. Okay.
Was he?
Okay. The article actually says that. Had I thoroughly read it, I would have picked up on it. But he recently sold his house, or one of his homes in California, paid $4 million for it a few decades ago, sold it for $20, so he did fine. But he admits in the article that he sold it because he, quote, needs the money, and that he continues to take movie jobs. He'd hoped to be retired, but he continues to take gigs doing voices for movies like the Sonic franchise because he needs the money.
Not just voicing it, he is physically in that thing. Yeah.
Oh, really?
He's
okay.
pretty public about that, and some.
I like his candor, but
financial mismanagement. Good candor. I like it too. You know what he needs is he needs
Armstrong Advisory Group, Mike.
Well, yeah, but he also needs that Adam Sandler Netflix deal, right? Like, hey, you're gonna just crank out like 30 movies, a bunch of redos on stuff that you've already done, and we're gonna pay you a bunch of big money because of nostalgia. That seems to be what he. There's been some good ones in there. Did you see the ads though for Happy Gilmore 2 coming out next year?
No, did not know that.
That was all over Netflix yesterday during the football game.
Yeah, I've seen the teaser with Happy and Shooter McGavin.
Yes, precisely. Markets have turned positive for the day. Dow, S&P, and NASDAQ all slightly in positive territory. We'll have a full recap for you when we're back at it tomorrow to close out the week, folks. Merry Christmas. Happy Hanukkah. Thank you so much for joining us. We will touch base again tomorrow. Have a great day.